Welcome to The Explainer. Today, we are digging into a topic that's honestly make or break for anyone in the transportation game: how to finance commercial trailers in a way that actually helps you grow, instead of just, well, running out of cash. So let's just start with a big question, right? How in the world do you buy a $100,000 piece of equipment, something that's supposed to make you money, without killing your cash flow? It's this constant battle, this tug of war between investing in the future and just surviving day to day. So here's how we're going to tackle this. First, we'll look at the cash flow problem itself. Then, the mindset shift that really solves it. We'll introduce you to some unique lenders, get into why different trailers get different deals, and then wrap it all up with a playbook you can start using right away. Okay, first things first, the cash flow problem. A new trailer is an amazing tool. It's designed to bring in revenue. But that giant price tag, it's a direct threat to the money you need for everything else. We're talking fuel, insurance, paying your people, the basics. And that is the tension. Right there, it's the core challenge. You absolutely need that new trailer to take on more work and grow, but buying it can literally starve your business of the cash it needs to operate. This is the exact spot where so many good deals fall apart, and it's why you need a different way of thinking. So let's talk about that shift. This is the solution. And it's not just about, getting a loan. It's a total change in how you approach the whole process. And the key is something called vendor financing. This right here, this is so powerful. When a dealer can offer you financing right there on the spot, the whole conversation changes. It stops being about this terrifying $80,000 number, and it starts being about a simple, predictable monthly expense. It becomes manageable. And this slide just lays it out perfectly. On the left, you're stuck thinking, how do I find 80 grand? That's a deal stopper. But on the right, the question becomes, can we handle $1,700 a month? Now that's an operational question. You can build that right into your budget. See the difference? That's how you go from just looking to being a funded buyer, ready to make a move.
All right, so who's actually providing this kind of financing? Well, you might be surprised to hear it's often not your traditional bank. There's this whole other world out there of specialized lenders who live and breathe the transportation industry.
And there's often a really cool story behind these lenders. Take the Mehmi group up in Canada. It was started by 5 immigrant brothers who really struggled to get funding when they were starting out. And that personal experience, it's baked into their business model today. It makes them way more open to funding startups and newcomers, people that a traditional bank might just turn away. And this chart just spells it out. Look at the difference. These specialists can get you an answer in days, sometimes even hours, not weeks or months. And they're not just looking at a credit score. They understand the assets. They understand your potential cash flow. They get the story behind the numbers, which is a total game changer. All right, so let's keep building on that. Have you ever wondered why you can get, say, a 72-month term on a basic dry van, but maybe only 48 months on a heavy-duty dump trailer? Well, the answer is all about the asset itself. It all comes down to this one term, secondary marketability. This is, without a doubt, the most important thing a lender is thinking about. All it means is they're asking one simple question. If this person stops paying me, how fast can I sell this trailer and get my money back? That's it. And this table is a perfect example of how that works. A standard dry van, it's like the Toyota Camry of trailers. Everybody wants one, they're easy to sell, so the resale liquidity is super high, and lenders feel safe giving you a nice long term. But a dump trailer? That thing gets beat up, it works in tough conditions, it's harder to resell. So the lender protects themselves with a shorter term. Makes sense, right? Okay, so now you know how the lender thinks. Let's talk about your side of the coin, because you're going to face a big choice that affects your cash, your taxes, your whole financial picture. Should you get a loan or a lease? So here's the bottom line. A loan is all about ownership. You're buying that trailer over time, and with every payment, you're building equity. For taxes, you're usually deducting the interest and depreciation. A lease, on the other hand, is about usage. You're just paying to use the asset. This often means lower payments, which is great for cash flow, and you can usually write off the entire payment as a business expense. There's no right answer. It's all about what your business needs.
So how do you take all of this and actually use it? Don't worry, we've boiled it all down into a simple, actionable playbook for you.
Just follow these 3 rules. First, have a network of lenders, not just one bank. You need a plan B and a plan C.
Second, change your mindset. Always focus on the monthly payment, not the huge sticker price. And third, make sure your loan term makes sense for the trailer's lifespan. You don't want to be paying for something that's worn out. If you do this, you're no longer just buying a trailer. You're making a strategic investment in your company's growth.
And really, that's what we want to leave you with. It's a shift in thinking. Is that next trailer just another big expense you have to deal with? Or is it a powerful tool that, when financed smartly, can be optimized to generate revenue and drive your business forward? The choice is yours.